Today's topic is provision for depreciation account. One of our students requested to make a video on this topic. We have a question here which is taken from A-level accounting first paper. Okay, so before we start, have a look at the question. Mu is a sole trader and prepares her financial statements to 31st May each year. Okay, she depreciates her motor vehicles using the reducing balance method at a rate of 20% per annum. Depreciation is charged monthly. Okay, Mu purchased a motor vehicle on 1st June 2013 for $152,000. On 1st March 2015, a new motor vehicle was purchased at a cost of $190,000. The old vehicle was part exchanged at a value of $84,000. The balance was settled by a bank loan repayable over 3 years. Okay. So now, what is our requirement? Prepare the motor vehicle provision for depreciation account for the years ended 31st May 2014 and 31st May 2015. Okay, so here 2 years account we need to prepare. So this is the second part actually. So on the first part I showed how to prepare motor vehicle account. Okay, so many things you can learn if you watch the first part. I'll link to this video on the description box. So here on the question we see many information. Okay, first step, we will write opening balance. We will check our opening balance, it is there or not. Okay, so before we write opening balance, so let us understand the financial year. It is very important. Many students don't understand financial year. If you cannot understand financial year, then it will be very problem for you to write the dates with that transition. Okay, and don't forget, dates carry marks. So on the question it is written that she prepares her financial statements on 31st May. That means she starts on 1st June. Okay, previous year. So it will be started from 1st June and will be closed on 31st May. Okay, so here like it will be 1st June 2014 to 31st May 2015. So what I was telling, opening balance. Okay, so if it is a new business, there will be no opening balance. If it is old business, there may be opening balance, maybe not, depends on the question, depends on the business. Okay, so in this question we see there is no opening balance for the provision for depreciation account. Okay, so don't forget opening balance, provision for depreciation account. So this has a credit balance. Okay, so if there is any opening balance, you must write on the credit side here. Okay, you write opening balance and you will write the provision for depreciation which will be given on the question. Okay, so step 1 in this case here we don't have opening balance, so we don't need to write. Okay, so step 2 here, we need to transfer depreciation to the income statement for existing asset. Okay, what is asset here? It is motor vehicle and the value is $152,000. okay, which was there in 2014. So here on the question we see she applies reducing balance method at the rate of 20%. Okay, so reducing balance method, so the cost price of the asset was $152,000. okay, so the rate of depreciation is 20%, right? So it is $30,400. okay, so this is the depreciation for the year ended 31st May 2014. Okay, good. So now we need to transfer, I said we need to transfer this amount, this depreciation to the income statement. Okay, how to transfer, what to write, where to write, debit side or credit side. Okay, when you transfer depreciation to the income statement, how we generalize? We write income statement to be debited, provision for depreciation account to be credited. Okay, So here provision for depreciation account to be credited. So we will write on the credit side. Okay. Don't forget, this is always same. Okay, great. So we write the depreciation, the income statement at the end of the financial year. So let us write here 2014 May 31st. So we will write here income statement. Okay, we calculated $30,400. Okay, so here on the question we had requirement, we need to calculate, we need to prepare this account year by year, okay, for 2 years, 14 and 15. So this asset was not disposed in 2014, okay, so there is no more transition in 2014. Now we will balance it, okay. So how to balance? It is simple. Let us write here the addition. Addition is here, same, $30,400. We will take it here, opposite side, $30,400. Okay. Now we will write balance CD. Okay. So balance CD, how much? The same amount, $30,400. So here we have 0. Yeah, we did not have any money. So 30,400 minus 0 equal to 30,400. Same amount. And CD stands for carried on. Don't forget. And what is the date for balance CD? It is the last day of the financial year, right? So it is 2014 May 31st. Okay. So same, this balance CD will be here again. Okay. This amount will be brought on to new financial year. So here balance CD will be written above the total and balance PD will be written below the total. Okay. So let us write here balance BD. BD stands for brought down. Don't forget. So same amount, $30,400. Now date. Okay. Date will be the first day of new or next financial year. Okay. So here financial year ends on 31st May 2014. So new financial year will be started on 1st June 2014. Okay. So let us write here 2014 June 1st. Okay. So this is the opening balance for this year. Okay. What we are doing in step 2, we are calculating depreciation for the existing motor vehicle. Okay. So now let us have a look at the question again. On 1st March 2015, a new motor vehicle was purchased at a cost of $190,000. The old vehicle was part exchanged at a value of $84,000. Okay. So here on 1st March, new one is purchased and old one is gone. Old motor vehicle, the existing motor vehicle which was purchased by $152,000, it is gone. Okay, it is no more in the business. It is exchanged to get a new one. Okay, so new asset is purchased on 1st March, right? 1st March 2015, and old was there until 1st March 2015. Okay, here until 31st May 2014 we calculated depreciation for the old one. Okay, now 31st May, that means 1st June from next year, 1st June 2014 to 1st March 2015, how many months? It is 9 months, right? So this old motor vehicle was there in the business for 9 months. Then after 9 months, on 1st March, the new one is purchased. Okay. So now what to do? We need to calculate depreciation for old one. So let us calculate here. So the amount, the cost price of the old one was $152,000. Okay. It is balance reducing method. Okay. Don't forget. So now we need to subtract the previous year depreciation, which was $30,400. Okay. So what we get here? We get $121,000 $600, okay? This is the net book value on 1st June 2014, okay? Now we will calculate depreciation on this amount for 9 months, okay? So the rate of depreciation is 20% and we need to calculate here depreciation for 9 months. So divide by 12 and multiply by 9, okay? We get $18,240, okay? Don't be confused. Why we subtracted $30,400? Because it is a balance reducing method, and the main thing of balance reducing method is we need to calculate the net book value to calculate depreciation for next year. So to calculate net book value, what you do, we need to subtract the previous year depreciation. So net book value equal to cost minus depreciation, okay? Then we need to multiply the rate. Okay, so here now again we will transfer this amount to the income statement, okay? Same thing like 2014 31st May, it is income statement we wrote here. So same thing, same way, same side we will write. So don't forget, I told you already, we always transfer depreciation to the income statement at the end of the financial year. So it is 2015 May 31st, okay? So again we will write here income statement. So here we calculated 80,214, okay? Very good. So now step 3, here we will calculate depreciation for the asset which is disposed, okay? So which asset was disposed? The asset, the motor vehicle which is purchased by $152,000, okay? It is now no more in the business. 1st March 2015, we purchased new one, and at the same time we disposed the old one, okay? So now the depreciation for the disposed asset we need to calculate, okay? It will come here on the debit side, okay? So now let us check. So here the value of previous existing motor vehicle was $152,000, okay? How much we calculated depreciation over the years, over the 2 years, 2 financial years, okay? First year we calculated depreciation $30,400, okay? $30,400 for full 1 year, okay? Full 1 year, 12 months. Second year we calculated depreciation $18,240, and this amount for 9 months, okay? Why 9 months? Because on 1st March we disposed this asset. So here 18,240. Now if we add here, we get here 640, and here we have 48,640. This is the total depreciation for the disposed asset, okay? So now we need to write on the debit side. Step 3, the depreciation of disposed asset, okay? We have to write. We write at the end of the financial year, which is 2015 May 31st. So we will write motor vehicle disposal account, okay? So we will write this amount 48,640, okay? So this is our step 3, and step 4. Now we have to calculate depreciation for a new motor vehicle, okay, which is purchased $190,000. Now my question, how many months the new asset was there in the business? It is purchased on 1st March 2015, and our financial year ends on 31st May 2015, right? So March to May, March, April, May. So 3 months. So now we have to calculate depreciation for this new asset, and we'll transfer this depreciation to the income statement, okay? So how to calculate? It is very simple. Let us write here. $190,000 was the cost price, right? So the rate of depreciation is 20%, okay? And this asset was there in the business for 3 months, multiplied by 3, and here we will divide by 12, okay, to calculate 3 months. Now after calculation, what we get? Well, if we say it is $9,500, you are absolutely correct. Okay, so this is the depreciation for new motor vehicle. So what to write, this side or this side? Never say this side, okay, because depreciation always comes on the credit side, okay. When you transfer depreciation, we need to write income statement always on the credit side of provision account, okay, don't forget. So come here again, we'll write same date 2015, financial year ends on 31st May. We'll write here 31st May, and we have to write here income statement. So here it is $9,500. Okay, this is step 4 is done. Now step 5, the last step, we need to balance it, okay, because we wrote everything here, nothing is left. Okay, now let us check which column is larger in money. So if we see our credit column is greater, yeah, okay, so here we have 3 amounts, here we have 1 amount, so here I think this is greater. So if we sum up, if we get the total here, it is here 58,140. So we'll subtract this amount from this total here. If we subtract, we get here 500 and here 9. Okay, $9,500. Okay, so this is called balancing figure, balance CD, and the date for balance CD will be always the last date of the financial year, which is 2015 May 31st. Okay, so this balance CD will be here as a balance PD. Okay, we need to balance, bring down. So let us write here balance BD. We'll write here $9,500, same amount, and the date for balance BD will be here 2015 June 1st, the new financial year. Okay, don't forget.